Reaction to Tesla earnings, Q1 2023. There's three big points that we want to make here. Number one, there is a demand situation right now that needs to be balanced between growth and demand, which is causing ASPs to come down. Number two, the margin situation will get better in H2. And number three, the excitement about the energy business continues. Volumes are growing, sales and profits not yet. Hopefully that will get better. They didn't make clear indications in the call, but this is definitely an area of excitement. This is the Not Even Wrong podcast. It's April 22nd, 2023. This is Krim Delco. For the day, the fund is down 20%. The market is down 0.5%. For the year, we are up 31.2%. The market is up 7.6%. We're outperforming by 23.6%. So let's get the big numbers first out of the way. The big drawdown comes from Tesla. After earnings, the stock was down 10%. We also had a drawdown before that of about 4%. So the whole earnings situation has been worth almost 15% in the stock. Today is 2 days after earnings. The stock is kind of stabilizing. Well, here's the situation, right? We had the production report at the end of Q1, which already was indicating that there's an inventory buildup. In other words, Tesla's production is outpacing demand. Now, we spoke about this after the production report, certainly not a good thing. We have to keep in mind Tesla is growing at a 50% clip volume, and demand is not growing that fast because we have a decline in the car market actually globally, so of about 15%, and that's why Tesla's demand is only growing roughly 35%. I think that is probably a fair assessment of the situation. Having said all of that, of course now the question begs, well, is this just really sort of a macro issue? Is this a more global problem with Tesla that maybe there is Rob Maurer said that in the call right after the production report. Maybe we're maxing out on 3 and Y, and we have to now start thinking about new products and so on and so forth. Those are all legitimate questions. I think the market is always good at finding an average price for the current situation. The market is not particularly good at pointing out every single potential reason for what's going on, and that's not really important for us investors. What matters is that the risk reward right now is priced wherever it's priced, $160 a share, probably about 35 times current expected EPS for this year. That is, I would say, a fair assumption. Maybe it's a little bit underpriced. The stock could be maybe $180, $190 given the performance. Because don't forget, we're in a recessionary environment. Everybody is, hurting around the world. I just came back from Europe. Inflation has hit Europe actually much harder than the U.S. Everything is expensive, and people can't afford it. And on top of that, they're losing their jobs. So this double whammy is just something that is hurting everybody. But my partner Zobinar said in the conversation right after the call, Tesla is not interest rate, macro, weather, or whatever type of company you want to name. In other words, they don't use excuses like that. So what's going on here? And I think the answer is, well, look, they're big enough to be affected by these types of events. These events come in both ways. They also come when times are good. Tesla is doing extremely well, like last year when demand was very strong. Tesla's pricing, ASP, and so on and so forth went through the roof. So it goes both ways. So that's why I think we are not terribly concerned. And I think the second point about the call, this call was all about margins. And the reason it was all about margins is because margins came down, right? And the street doesn't like that. You have volume growth, you have sales growth, but you have earnings decline because margins are coming down. What is going on? Well, if you look at the actual numbers, you can see that the ASP is down around 10%, and gross margins are roughly down 10%, and everything else trickles through the P&L. We believe that they will be able to improve the cost structure in the back half of the year, that a lot of the macro headwinds, which are now causing demand to slow down, will also trickle down into the cost structure, commodity prices, wages, all those kinds of things, so that there will be a couple of points of margins improvement. We believe that we can still have maybe low to mid-20s automotive margins. And if we can deliver that, then we could have a full year automotive margins in the low 20s, and therefore an operating margin in the sort of mid-teens, and go from there, which is obviously phenomenal in a year where demand is not pacing in lockstep with production. That's the main message here. So we believe we can still have a pretty good year here. It's just that Q1 was very bad because we have now we have the full effect of ASPs hitting, coming down, but not the full effect of costs coming down. This is, I think, the big message for Q1, the sort of positive message. There wasn't, the feeling of the call was certainly negative. The feeling of the call was almost a little bit sarcastic in a sense that, Musk was talking about the macro environment and things like that. And that's usually not a good thing, right? That's not a good thing when, people like Musk, they should be focused on what they really want to achieve with the company and not spend too much time with macro comments and so on and so forth. So the feeling was certainly not good, but I believe that we have sort of, grown into this almost Pavlovian expectation now that, production is outpacing demand, inventory is going up, ASPs are coming down, this is all bad, right? And then the whole feeling of the call is bad, and it affects even management. I think Zach kept it pretty cool in his typical form. He was very calm and controlled, and he gave this message that, listen, it's going to get better. He didn't commit to it, and he certainly doesn't control every single thing about the company, so he can't really make those commitments. But I think he gave me, and hopefully most of other investors that care about this company from an investor perspective and not an analyst perspective, enough confidence that this will get at least it will get better in the second half, and that therefore we can have still a pretty successful year. He said that also in the Q4 call in January, and that was part of the reason why there was a rally in the stock. And now it's correcting because the numbers aren't that good, and he wasn't committing as much anymore to, let's say, a better second half of the year and a full year, a better picture of margins. But I still think that's in the cards. I think the third thing that is very exciting about the call, it is actually the energy business. Grew 360%. Sales grew 150%. So we went 4.5x in volume. We went 2.5x in sales. Now, what's going on here? I think the energy business is going to look a little bit, let's say, like the flash memory business. So in that sense, it's very much a storage business, where you have volume growth always outpacing sales growth because pricing ASPs are coming down. And that's just the nature of the business. The one thing that is still lacking is a clear line of sight of profits. Okay, Zach said they want to have a mid-20s gross margin in that business, which could be perceived a little bit as negative, but to me that's not so important actually. I don't care whatever the margin is, commit to it, run the business like that, and if we have a business that can be, in the hundreds, if not terawatt hours type size business, then 25% gross margin would still make a big contribution to the bottom line. So again, maybe it could be higher, maybe it could be lower. That's not the point. If they decide to run the business with a 25% gross margin on the energy side, then that's how they're going to run the business, and it's going to look very much, I think the energy business is going to look like, let's say, Micron or the Samsung flash memory business. So it's always going to be very strong volume growth. ASPs will come down, therefore sales growth will be less rapid than the volume growth, and then profits will just come in at like the mid-20s clip. So those are the big three takeaways. Again, I spoke a little bit about the feeling of the call. It was certainly not positive, which explains the massive correction in the stock. I would say, as far as investor questions are concerned, the focus really was on cost, because that is the driving factor now. Okay, we have a demand situation. It is what it is. We're going to have probably a little bit more ASP adjustments here and there, but overall, the big lever now is cost. Like that is where we see a lot of opportunity for margin improvement. We still have growth, maybe in the mid-30s in volume. We can have the same type of sales growth year over year. And then if we can manage margins to the low 20s at the GM level, meaning gross margin level, then that is still a very good year. And that is a question of cost, which is under the control of the company. And they said it several times. I think it sounds a little bit like a cliche, but they will come out stronger of this because they're so laser focused on cost. Even though they're a margin leader now in the industry, they still are laser focused on cost, a lot more laser focused, in my opinion, than most other companies, particularly in the automotive industry. I think finally I want to say, look, we compare Tesla to the automotive industry. There's a little bit of a, I would say, almost schizophrenic attitude of Tesla when it comes to these things. On the one hand, they're an automotive company. On the other hand, they consider themselves not an automotive company, but a software technology company. That is certainly something that maybe should be clarified a little bit by management and also in conversations that we have with them. Maybe we should have a much clearer position. Okay, listen, what exactly are you? Like, you have a mid-20s gross margin target that is much higher than automotive. So clearly you're not an automotive company. What exactly, how should we think about Tesla? You know, Tesla looks to me a lot more like a company like Samsung with some very high-tech components, some lower-tech components, some volume components, like the storage business. What exactly, where do you stand? And that's certainly something that I would like to have a little bit clarified. So to summarize the three big takeaways in the call: number one, production's outpacing demand, which has driven ASPs down and could also continue pressure in ASPs. Second, the margin situation will improve because a lot of the margin hit has come through ASPs already, but the improvement on the cost side will trickle through in the next 2 to 3 quarters. And three, the energy business is exciting. We're very excited. The growth is now, we're already at 16 gigawatt hour annual production, which is almost half of the capacity of Lathrop. So that's a real contribution in terms of volume. Sales, not so much, and profit, not yet, but it will come, and that's very exciting. That's very important. Tesla will have new revenue stream, which is, by the way, another thing that I think will come now. We will have the Cybertruck launch, and we will have the energy business. So we have two vectors of drivers of sales and profits, which will come on top of the existing business, which is exciting. Thank you.